You've seen the headlines. World on the brink. War is inevitable. Markets about to collapse. Every few days it feels like the language gets louder, sharper, more absolute. And when headlines get this emotional, investors usually do one of two things. They panic or they tune out completely. Today, I want to do neither. What I want to talk about is the quieter path to global conflict. The one that doesn't involve dramatic breaking news banners, but shows up in shipping insurance rates, reserve currency behavior, defense supply chains, and long-term commodity pricing. It's not the kind of war scenario most investors are positioned for. And that's the point. If you're looking for fear, there are plenty of channels serving that already. If you're looking for clarity, context, and a framework for thinking about risk, that's what we do here. Welcome back to Financial Briefing. Before we get into the data, I want to ground this conversation with some accountability. Not predictions in the dramatic sense, but scenarios we've discussed here before and how they actually played out. Back in early 2023, when banking stress was dominating the narrative, we said gold breaking above 2,000 wouldn't be about inflation headlines, but about trust in the system. At the time, gold was around 1,850. Within 4 months, it traded above 2,050, not because CPI exploded, but because liquidity risk re-entered the conversation. That call wasn't perfect, but the direction and the reasoning held. In mid-2024, when silver was pushing through $28 and some channels were calling for an immediate squeeze to 50, we said momentum was real, but positioning was crowded. We expected consolidation, not collapse. Silver topped just above 30, pulled back into the mid-26s, and then rebuilt its base. Again, not dramatic, but structurally accurate. And late last year, we talked about energy markets. Specifically, that Middle East escalation would likely raise volatility, not permanently spike oil unless shipping lanes were structurally impaired. Brent briefly surged, then normalized. That mattered for inflation expectations, yields, and precious metals. I share these not to claim clairvoyance, but to show the process. We look at probabilities, incentives, and second-order effects. And that same approach matters here, because the global war risk investors are focused on may not be the one that actually impacts markets. Let's start with the first data point. Global defense spending in 2024 reached approximately $2.4 trillion. According to aggregated NATO and non-NATO disclosures. That's up roughly 6.8% year over year and nearly 30% higher than the pre-2020 trend line. Historically, defense spending surges like this happen either during active global conflict like the early 1940s or during prolonged Cold War phases like the 1950s and 1980s. What's different now is that this increase is happening without a declared global war. It's happening through regional conflicts, alliance commitments, and long-term procurement contracts. What it means is that governments are preparing for persistence, not a quick resolution. Supply chains are being redesigned for resilience, not efficiency. And that has inflationary implications over a multi-year horizon. What it does not mean is that a hot, synchronized global war is imminent. Defense spending is often front-loaded precisely to deter escalation. High spending can be stabilizing in the short term, even if it signals long-term rivalry. The second data point is global shipping insurance premiums in key choke points. Since late 2024, war risk premiums for vessels transiting the Red Sea and parts of the Eastern Mediterranean have increased between 300 and 500%, depending on flag and cargo. To put that in context, during the height of the Iraq War, premiums rose sharply, but normalized once convoy protection and clear rules of engagement were established. Today's premiums are elevated not because ships are constantly being hit, but because the risk is undefined. Uncertainty is what insurers price most aggressively. What it means is that trade friction is increasing even without full-scale conflict. That quietly raises costs, slows delivery times, and pressures emerging markets more than developed ones. What it doesn't mean is a collapse of global trade. Volumes are rerouting, not disappearing. This is inefficiency, not paralysis. Markets can absorb inefficiency longer than they can absorb chaos. The third data point is central bank gold purchases. In 2023 and 2024 combined, central banks added over 2,000 metric tons of gold to reserves. That's the highest two-year total on record. Historically, large reserve reallocations happened during regime shifts. At the end of Bretton Woods, the post-Cold War reordering, the early 2000s dollar cycle. What's notable now is that these purchases are concentrated among non-aligned or semi-aligned countries. What it means is not an imminent dollar collapse, but a slow hedging process against geopolitical fragmentation. Gold is being used as neutral collateral in a world where trust is conditional. What it doesn't mean is that gold prices must immediately explode. Central banks buy quietly over time. Their behavior supports the floor more than it creates the ceiling-blowing spikes that headline writers love. Now, if we step back and ask, could this all resolve into a bullish scenario for precious metals driven by escalating global conflict? The answer is yes, it could. The bull case looks like this. First, prolonged regional conflicts slowly converge through alliances, sanctions, and retaliation. No single trigger event, but a gradual widening. That raises tail risk premiums across assets. Second, defense-driven fiscal spending keeps deficits structurally high, limiting how restrictive monetary policy can remain without causing instability. Third, emerging market currencies face pressure from trade inefficiencies and capital outflows, increasing local demand for hard assets like gold and silver. And fourth, silver specifically benefits from both monetary hedging and industrial demand tied to defense, energy transition, and infrastructure hardening. In that scenario, gold sustainably holds above 2,300, silver pushes into the mid to high 30s, and volatility remains elevated. I assign that scenario roughly a 25% probability. But it's important to balance that with the bear case, because this is where most narratives fall apart. The bear case starts with the reality that markets are forward-looking. A lot of this risk is already partially priced. Defense stocks have re-rated. Gold is not cheap on a real yield basis. Volatility is elevated. Second, major powers still have strong incentives to avoid direct confrontation. Economic interdependence hasn't vanished. It's frayed, but it's still there. Third, technological deterrence changes the calculus. Cyber, space, and economic warfare allow pressure without tanks crossing borders. And fourth, inflation continues to moderate enough that central banks retain credibility, keeping real yields from collapsing. In this scenario, precious metals consolidate. Gold trades sideways between 2,100 and 2,300. Silver ranges between 27 and 33, frustrating both bulls and bears. I give this outcome about a 30% probability. Which brings us to the middle case, and this is where I actually think we land. The most likely scenario is not global war and not global peace. It's a prolonged gray zone environment, ongoing regional conflicts, sporadic escalations, constant diplomatic strain, and a world that feels unstable but remains functional. In this environment, investors periodically panic, then recalibrate. Metals benefit on dips, but don't go vertical. Volatility becomes episodic, not constant. Gold slowly grinds higher over years, not months. Silver outperforms gold during reflation bursts, then underperforms during risk-off phases. This is not a cinematic outcome. It's a frustrating one, and that's exactly why it's likely. I assign this middle path about a 45% probability. To understand why this pattern repeats, it helps to look at history. A useful comparison is the period from 1977 to 1985, the late Cold War era. You had proxy conflicts, energy shocks, arms buildups, and constant rhetoric about existential threats. Gold surged in 1980, then spent years digesting gains. Silver famously spiked and collapsed. The similarity is the combination of geopolitical tension and monetary uncertainty. The difference is credibility. In the early 1980s, central banks reasserted control brutally. Today, policy is constrained by debt and demographics. So while the emotional texture feels similar, the market mechanics are different. That argues for sustained hedging demand, but fewer blow-off tops. Cross-market signals reinforce this. Gold is firm, but not panicked. At around 2,250 to 2,300, it reflects concern, not fear. The dollar index remains relatively strong, suggesting global demand for liquidity hasn't collapsed. That's inconsistent with imminent systemic breakdown. The 10-year yield hovering around the mid-4% range tells us markets expect slower growth, but not depression. Taken together, these signals say uncertainty, not catastrophe. Positioning data adds another layer. Commitment of traders reports show managed money moderately long gold, but not at extremes. Silver positioning is lighter, which actually supports upside optionality. Banks are not heavily short metals at panic levels. Institutions are hedging, not betting on collapse. So here's my personal action plan. If escalation remains contained and metals pull back 10 to 15%, I add incrementally, no leverage. If gold breaks below 2,050 on rising real yields, I reduce exposure. If silver clears 36 with volume and without speculative blow-off behavior, I let winners run. Currently, my allocation is roughly 12% gold, 6% silver, 4% miners, and the rest diversified across equities, cash, and short-duration bonds. My risk management matters more than my conviction. My stop loss on speculative silver exposure sits around 24. My take profit on short-term trades begins above 38. This is not advice. It's just my framework. What am I not doing? I'm not panic buying because of headlines. I'm not consuming fear-based content all day to justify a position. And I'm not assuming systemic collapse is the base case. History punishes that assumption more often than it rewards it. Finally, what am I watching this week? First, shipping insurance rates. If they spike again without a corresponding incident, that signals rising perceived risk, bullish metals. Second, real yields. A sustained move above 2% pressures gold. A rollover supports it. Third, central bank communication. Any hint of tolerance for higher inflation changes the long-term metals outlook. So to summarize, geopolitical risk is real, but often misframed. Markets price probabilities, not narratives. Precious metals benefit most from persistence, not panic. And discipline beats drama every time. If this kind of calm, data-driven analysis helps you think more clearly, consider subscribing. That's how we keep doing this without selling fear. Thanks for watching Financial Briefing. Stay sharp.